Hello, this is going to be Centennial Scholars for May of 2020. I'm glad you were able to hop on and check this out. I was hoping to do it in person, but we're not to that point yet. Hopefully we will be some point later this year, but for right now, through the miracle of technology, we can still get some things done and still do presentations like this. So let's get going. So our agenda today, we're going to cover the business continuity, what we're doing at Centennial to serve you. We're going to do a market overview. We're going to cover where we've been, where we are now, some unique things that are market-based but maybe not economy-based, and explain a little bit about the saying that the market is not the economy, which if you haven't heard already, you're going to be hearing a lot probably. And then in a new normal, we're going to cover kind of some predictions for the future, some emerging trends we're seeing, and some things that we thought were going to be big this year that turned out to be small, and things we thought were going to be small that are becoming massive. I thought you'd enjoy a picture of my new office window. So this is my setup for right now. I've got my computer, my iPad set up, and printer. If you notice right behind my iPad on the left of the screen there, you'll see the neck of a ukulele, because the office in my house doubles as a music room. Behind me right now are a violin and a French horn. So, you know, that's kind of how everybody's dealing with it right now. You make do, and in our case, in making do, my wife has the room across the hall for her to work in. I have the office here for me to work in, but they both double as school rooms as well. From Centennial's standpoint, we activated our business continuity plan. We're technically an essential service, but we've limited staffing in the office. So all the advisors are working from home. The sales assistants, so Julie is rotating through once or twice a week, but everybody's able to work from home that can't or isn't in the office. We do have people there. It's usually 4 or 5 people in the office every day. So we're able to make things work. So we are essential, but we're being cautious in having people work from home. And actually, we last week had a group come in and do a deep disinfecting of the office that's supposed to be really good stuff. So we'll see how that goes. This does, now that we know everybody can work from home, it is going to give some future flexibility to have people out of the office a little more often. We've got some other changes coming up soon that will give us even more flexibility. So there may be some more voluntary work from home in the future for us at Centennial, myself included. On to the market overview. 2020 has been a historic year, and I don't think I probably need to say it, but just in case you didn't know, it's the fastest peak of a market to a bear market in history. And then we recovered quickly from about March 23 through today. It's not a surprise, I don't think, to say that the market overdoes everything. And to my thought, we overdid the down, and we've probably overdone the up at this point too. But again, the market overdoes everything, so it's not too surprising. The chart on this page is interesting to me. It shows just how volatile things were in March. And we know it was crazy and there were big moves every day. But in the history of the US market, we had never had a month where the average daily move was more than 3.9%, and that was right at the start of the Great Depression. March of this year was not only over 4%, it was over 5%. It was such an outlier that it was probably something that people didn't even think was possible. If you look at the very far right on that chart, you can see a comparison between the market volatility in January on the top, where it was all fairly calm, and then March on the bottom, where it was just bonkers every day. In fact, we went about 3 months without having a single daily move of more than 1%. And then, like I said, in March, we averaged 5.3% a day. That's just how volatile and how out of the norm for what we'd gotten used to March was. So I mentioned it was a really big, really fast move on the way down. It's so fast that in the chart on this page, it's hard to see where we went down and where we went up. It was so quick and so big that it just looks like a line down and maybe a little bit of a line up. So I did my best to zoom in. And when you zoom in here, it's still kind of hard to see. The bottom of the spike, like I said, was March 23. The green dot furthest on the right, right by where it says minus 14%, that was on April 30th. So, and on Friday we ended at 29.29 on the S&P 500. That's up another 17 points from the end of April. This is all uncharted territory from the world and the virus to the market. And so everyone's trying to make sense of it all. And that's part of the reason why we've had these big moves is there's just so much news that people are trying to digest, and it's moving things fairly quickly, although it has calmed down a lot since about the end of March. This is one of my favorite charts. It shows the intra-year drawdowns and the end-of-the-year performance numbers. So you can see we were down 34% all the way on the right there. We were down 34% at the bottom this year. That's the low number we've hit so far. It's possible we could go down there again, although I don't think so. And then year to date, the drawdown is much less. As you can see from the chart, it is possible to have a draw as big as we did and still be positive for the end of the year. But who knows what the rest of the year, what the next 7 months will bring. The price earning ratio numbers, which are used as a way to try to value stocks and value the market, it's commonly called the PE ratio. It's been changed a bunch so far this year, and that mostly it's been impacted by both the numerator and the denominator, both by price and by earnings. We had big price drops before the earnings had changed, and so then you got this big pull down that you see, and then the prices have started to come back up, and companies reported earnings for the first quarter, and some of them were down, obviously, and so then it's changed both parts of the equation there, both parts of the fraction. And then bears watching, pun intended there. Bears, are the people who are pessimistic on the market. They're going to be closely watching the PE number, as will anybody else, but especially those that are pessimistic. They're going to be watching that and using that as one of their reasons why they think the market is overvalued and why we're set to drop. Moving on to mitigation, there's been a lot of financial impact from the mitigation steps trying to reduce the virus impact. And so the administration and Congress finally got together and came up with the CARES Act. And then there were some supplemental bills, or was a supplemental bill passed. They're working on another one. And so the chart here kind of lays all of that out. It shows the interventions so far. Like I said, there's probably more coming. So it does include the CARES Act, the supplemental bill that was passed. The supplemental bill was basically to add more money to the Payroll Protection Plan program, the PPP program for small businesses. That's probably going to get more money added to it. There's going to be state and local help coming, although that's going to be a little more surgical because there's some concern about, states just taking the money and throwing it toward their underfunded pension plans and things like that. I don't think that's probably what's going to happen, but there are going to be probably protections in there to make sure that isn't the case. And there may be more for individuals coming too. There may be more checks coming for individuals. I know that's been talked about a lot. I don't know if that is going to happen. But my biggest problem with this whole program is it was framed as, relief and stimulus. And I think if they would have framed it more as an eminent domain kind of program, I think it would have been viewed even more positively, not to say that it's been viewed negatively, but if they were to say, it's like eminent domain, we're going to pay you the fair market value because we, the government, are telling you to shut down, I think they probably could have done things a little bit differently if they framed it that way. That might have been more helpful. But also, you probably wouldn't get the people out there searching for fraud and for companies that maybe don't need the money but took some anyway. It gets rid of that concern if you just say, hey, we told you have to close. We're going to cover what you would normally be doing for this month because we made you close. And then the needed but is, look, this was clearly needed. It was very important, and as is and will be the increased amount that they do. But this is going to increase the national debt significantly. That's kind of the right two pieces of this chart. And so that is something that will have to be worked on in the future. I'm not concerned about the U.S. government defaulting because, frankly, we own the printing press. So it's not going to be a problem there. It so far hasn't impacted anything. Treasuries are at historically low rates, but we're, still kind of the cleanest dirty shirt in the laundry. We're still viewed very positively the rest of the world, so money flows in. There's no concern about a company like China dumping their bonds because they, for other reasons, need to have some of our bonds. So it's not going to be an issue immediately, but down the road it certainly could be. And so it'll be something that bears watching in the future. So the U.S. Federal Reserve, if they haven't been the most aggressive in the world, most aggressive central bank in the world, they've certainly been close. They cut rates early. They've offered a bunch of platforms that first kind of got tested out in 2008 during the financial crisis. And then they've gone above and beyond there. They kept the credit markets from freezing. They allowed companies like Boeing to raise capital in the bond market rather than through the government. There was talk of a bailout for Boeing. And once the Fed came in and did some of the actions they were doing, Boeing is actually able to issue their own bonds and didn't have to go to the federal government, which is great. Warren Buffett, during his annual meeting for Berkshire Hathaway, was very complimentary of the Fed chair, even though it cut off some opportunities for Berkshire to make some money. In 2008, they were kind of the lender of last resort, and so they were able to get really good deals for Berkshire. This time around, they were starting to have some of those conversations, and then the Fed really got in there and started taking action. And so those opportunities went away for Berkshire, but were there for the U.S. government and the Federal Reserve to do. However, by doing this, the rates have been pushed way down. We are at historically low levels. Before this year, the 10-year Treasury had never gotten below 1%. We did that. A few days later, the 30-year went below 1%. We've kind of stabilized now. The 10 years stayed about 0.7% for the last month or so, it's been fairly stable. So we've seen stabilization, but you can see on this chart that yields are way below where they have been in the past. The dotted line on that chart, if you can't see it real well, was December 31st of 2013. And we were on a 10-year yield, we were over 3%. And now we're down well below 1%. So the yield curve has gotten squished, and it's probably going to be this situation where it's lower for longer. I can't imagine that there are too many people interested in getting 1.28% back per year for 30 years on a treasury bond, but that is what they're selling for right now. So as we'll get into in a little bit, the stock market has moved well, and that's kind of one of the reasons why. It's because nobody wants to lock their money up for 30 years at 1.25%. The Fed did come out and say that they're unlikely to move until the economy is close to full recovery, whatever that means and whenever that is. So we're going to be looking at lower rates probably for a significant period of time. So I mentioned we're going to be covering the expression, the market is not the economy, or sometimes you'll hear the economy is not the market. It's been thrown around a lot. If you haven't heard it, you probably will in the future. And I just wanted to try to explain what it means, what the recent market moves might have to do with that, and so we can kind of have a constructive conversation on that and see why there might be some logic to the bounce back we've seen. So the chart there on the right shows the sectors most impacted by not just the virus, but the shutdowns and things like that. So we've got hotels, tourism, transportation, which is airlines and cruise ships, entertainment, restaurants and bars, and retail. Those areas combine for about 19% of the U.S. GDP, gross domestic product, about 20% of jobs, but only about 7% of the earnings of the S&P 500. So in the economy, they're about 20%. In the market, they're a much smaller portion. And there's a couple big reasons why. One, the S&P 500 is large cap companies. So those are the biggest, it's supposed to be the biggest 500 companies in the U.S. And so a lot of, if you think of a lot of restaurants and retail, they don't fall into that category. Also, a lot of the restaurants and retail that you would think of, they're not publicly traded. I mean, you can't go in and buy shares in your favorite neighborhood restaurant. So that impacts it as well. They're just not participants in the stock market, and so they don't have the impact there. So one way you can look at the S&P 500 is to look at the pieces, the constituents. So the top 10 holdings of the S&P 500 make up more than 25% of the index. And this is what I call the official top 10 of the S&P 500. And so I made this chart to show how these companies have done so far this year. And I use revenue instead of earnings because it's harder to manipulate revenue. Earnings you can kind of throw the kitchen sink at if you already know you're going to have a bad quarter and get everything out of the way. So for this, I use revenue because it's just harder to manipulate. Sales are sales. It's harder to push those off, recognize them later, things like that. Of the official top 10, only JP Morgan had negative revenue growth in the first quarter from the first quarter of 2019. Berkshire doesn't provide revenue just because of the kind of business that they are. So, really, if you want to think of it this way, 8 out of the top 9 had revenue growth. Now, I said this is the official top 10, but you might notice right in the middle there that there's Alphabet Class C and Alphabet Class A. Those are both Google, but they have two different share classes because they have different voting rights. So I went through and created an adjusted top 10. The adjusted top 10 combines the two alphabet pieces into one because they are one. It's the same company. The numbers are all the same. It's just different share classes. So by doing that, I took number 11, which is Procter & Gamble, and added it in as the 10th holding for the top 10. Even here, the numbers remain strong year over year. In the official top 10, year over year revenue growth for the total group was just over 11%. Here it's 10.7%. So by including Procter, drops down a little bit, but it's still pretty strong year over year, especially when you're talking about the biggest companies in the US. It's hard to get big, strong revenue growth because they're already so big. And this is my thought on why there could be some recent market strength, because the winners right now also happen to be the biggest companies. We know of a company, or I've heard of a company, that had to buy 5,000 laptops to have people set up to work from home. Well, all of those are going to have Microsoft's Office suite. They're going to use Windows. And so there's a bunch of revenue there that probably wouldn't have been there without this. Certainly Amazon, I see the Amazon truck drive by my front window every morning, dropping off things for, I would say, my neighbors, but I'll be honest, there's a lot coming here too. So that, I think, explains some of the market strength, is that the biggest companies, the ones that are making up the S&P 500, are also the winners coming out of this. And also, there's no chart for this, but the textbook belief is that the market looks 6 months out, which if you go 6 months out from now, you're early November. Hopefully, at that point, we would be in an economy that's open, or at least more open than now, better employment numbers. Of the 20.5 million jobs lost in April on the non-farm payroll report from last Friday, more than 18 million were listed as temporary laid off. Now, certainly not all of those jobs are going to be coming back, but fingers crossed, maybe a lot of them do. And in that case, maybe the market impact or the economy impact isn't as big as kind of the worst case scenario that everybody had feared. And so the market makes a little bit of sense that way. So kind of looking onward, eventually we will get back to normal, whatever that is. It might be different than what normal was before, but we will reach a normal point. And so then the big question is, what shape will the recovery be? We're simple people, so we look at the charts and go, that looks like a V, and that's how the recoveries get named. So, will the recovery be a V like it was in 2008, 2009? More of a U shape like the tech bubble in 2000 and 2001? Hopefully not, a W like in the 70s, but certainly that's possible. V's are pretty rare, but 2 of the last 3 recoveries actually have been V's. If you go back to 1987, that was also a V-shaped recovery. So a lot of it probably is going to depend on action coming out of Washington in the next 6 to 8 weeks, and states opening successfully, and also just the science working. The rate of technological advancement in the vaccine and the therapeutics and the FDA getting on board and trying to rush this stuff through has been incredible and historic, and hopefully that pace can continue. That would help a lot too. What we don't want is what's known as an L-shaped recovery, which is down and then flat, like a capital L. So we need to see economic recovery happen to avoid that, and we're starting to see that in areas. And assuming we can avoid the L-shaped recovery, then the question becomes, is 2020 a virus-induced blip on the radar, or the actual interruption of a multi-year bull run that we seem to be kind of in the early stages of? I think the demographic tailwinds are enough in the U.S. that this will be viewed as a blip on the radar, but some of that depends on what kind of activity we get, assuming we get a vaccine at some point in the next year, things like that. But there's enough of a demographic tailwind behind us that it seems like we should be in the early part of a multi-year bull run. The millennial generation is now the largest generation. The first millennials, including my wife, are turning 40 this year. And in general, they're doing all of the things that the prior generations did, forming households, moving to the suburbs, all of that kind of thing. But they're doing it later in life than prior generations. I heard someone speak last year, and they said, if you're only going to live to 70 or 72, if that's life expectancy, then you start your adult life earlier. With life expectancy now so much longer, they don't need to start the grown-up phase of life, and it's grown up with quotes around it, phase of life early. There's more time to be what they call an emerging adult, which is, maybe you're living with 3 friends in an apartment in the city or something like that, before you get married and start having kids and doing all of the things that all the generations before you did. Like I said, it's happening now. It's starting to happen. It's happening later than prior generations, but that snowball is picking up speed. It's coming. So I'm not going to predict what the market's going to do, because that's a fool's errand. But I do want to talk about some predictions of behavior changes and trends emerging and accelerating in the wake of the virus, and then all of the mitigation steps. So productivity has remained relatively high with everyone working from home, or most people working from home, which is likely going to lead to location flexibility in the future. So office workers are going to probably have some more flexibility in the future to work more often from home. We're seeing that in our office. I know others are seeing it as well. Usually the big argument about not having people work from home was that productivity is a whole lot less. And what they're finding out now, in what is basically a giant experiment forced upon people, is that even with people working from home and having to do homeschooling and things like that, they're still getting the job done. So there's probably going to be a lot more flexibility in the future. Video first, Zoom has become a verb, which the company Zoom has become, hey, I'll Zoom you, or hey, let's have a Zoom. And we're going to see more video calls and probably less face-to-face business, especially including business travel. Personally, I still prefer face-to-face, but it's not always going to be an option, or always going to be appropriate, or always one that makes the most financial sense. And so I think video conferencing, video conversations, that's going to be a bigger and bigger thing going forward, especially now that people are getting comfortable with the platforms and the technology. Global supply chains were disrupted a lot during all of this. And so we're seeing a lot of companies talking about moving their manufacturing closer to home. When it's, as it was the case in January and February, when your production facility is in China, if something happens there, then the facility is shut down. B, it takes a long time to get ramped back up, and it takes a long time to get things over here in large quantities. So a lot of the supply chains, they're talking about moving closer to home to have a little more control, have them be a little closer, reduce some of that transportation time. And that is especially going to be the case for things like vital medical needs. That's been a big thing with the personal protective equipment. There was very little to none produced here in the U.S. When we needed some, it took a long time to get it, and some of it, frankly, got pit stopped along the way. So things like that, now that they've started to be made at an ad hoc basis here, a lot more of that is probably going to be moving here in the near future. E-commerce was already huge. I don't think I'm breaking any new ground there. I mean, Amazon is massive. But this trend is probably going to be, it's been accelerated, and it's likely going to have long-lasting impacts, especially on the brick-and-mortar retailers, the ones where you go to them. Once you get comfortable shopping for everything online, do you go back to the in-store experience? Is there enough there to make you want to go shop at the mall? That is going to be the big question going forward. And likely, it's going to cause some of the retailers some real pain. Housing has been one of the biggest surprises. There's been a big jump in home sales through April and into May, probably because lots of people are deciding they'd rather live in a house with a yard than an apartment complex with hundreds or thousands of people in a small area. It's a little surprising because it's been, in many places, illegal to go look at houses and view them. So it's been a lot of virtual tours and things like that. But things have picked up in the housing market in a big way outside of just it being the spring season, and that's when things happen. So that probably relates back to my point about millennials in the last slide. But that trend is likely to continue also as people go, maybe I don't want to live here. On the other side of that, there are a lot of questions about the viability of long-term care facilities in the future. One of the big investment thoughts going into the year was, and not just this year, was that long-term care retirement home facilities were going to be a big deal as the baby boomers get older and start moving into those kind of places. Well, with all of that, everything that's gone on, where you've had most of those facilities locking their doors to visitors, so you can't go visit family members, and then large outbreaks in retirement homes that have really caused destruction to people. I saw a stat yesterday that basically a third of all of the coronavirus deaths in the U.S. have been at some sort of care facility or the result of someone living in a care facility. In fact, 13% of all of the deaths in the U.S. are just from retirement facilities in New York and New Jersey, which is a crazy, crazy amount of people in a very small footprint. And then we're starting to have an idea of the winners and losers coming out of this. And so some of the winners are, I mentioned Zoom, certainly Clorox, companies like that. Those are the winners. The losers, the obvious losers are, the cruise ships, Carnival Cruise Line, any airlines. But, the story is far from written. There will be more winners and more losers that kind of separate themselves from each other over time. And we're starting to see some of those trends. I mean, certainly any company that comes up with a vaccine or a therapeutic for the coronavirus is going to be a winner. Interestingly, RV manufacturers and lots are really seeing some big numbers, and it's because the thought is, well, who wants to go stay at a hotel, or who knows who stayed in the room before you, and who knows how well they really did cleaning it up? when you can travel from place to place in basically your own room where you know who was there because it was you, and you know who cleaned it because it was you. So that is something that wasn't at the top of my mind, but seems to be an emerging trend. And there will be others that seemingly come out of left field, both on the upside and the downside in the future. All right, well, I'm going to go ahead and leave it there. I know I threw a lot at you, especially toward the end. So if you have any questions, the phone number's there. It's the office phone number, but even if I'm working from home, they can patch it through to me. So go ahead and call me there. You can send me an email or visit my website, jeffwieringa.com. I'll be posting this video there in a few days, and it'll be available for anyone to see. So if you know anybody that maybe could use a little bit of help and you think this video might help them, please go ahead and send them there. I have been posting roughly weekly in the content library portion of my website. It's usually a blog post, a written post. So check back there often for my updates. Sometimes it's just, hey, I read this really good book, and sometimes it's me trying to get my thoughts about the market down on a piece of paper. So check back often. Thanks for sticking to the end. Have a great day, and hopefully we'll be able to see you real soon.